You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are excited to be back with this week's edition of the Systematic Investor series, which is our weekly, ongoing, and pretty raw exploration of the world of rule-based investing, and of course, where we also take some of your questions. So since I'm stateside this week, I can safely say good morning to you, Jerry, and then good afternoon to you, Moritz. How are you?
Good morning, Niels. Good morning, Jerry.
Good morning.
Good morning.
Good. Now, this week, I noticed that there were still a few big moves, in particular in energies. I noticed that there was a lot of green colors when we look at equities, which probably will please some in this group and maybe not so much others. We'll see. But then, of course, when I was having my healthy breakfast, I have to say, this morning at the hotel and was reading the paper, I saw this quote, because of course this week was marked by Jack Bogle's passing, and there was this picture of him and a quote of his where he basically says the greatest enemies of the equity investor are expenses and emotions. And to some degree, I think that's quite fitting for a lot of the things that we talk about. I know you, Jerry, on the, well, I guess for all of us, of course, we agree on emotions being a big troublemaker in the world of investing. And of course, when it comes to fees, you offer very competitive fee structures on the fixed fees, Jerry. We, on our side, of course, never charged a management fee in 45 years. And so I think those two things that he was quoted for are very fitting for what we are also trying to do. So with that said, why don't we jump into the usual routine, finding out what's has been going on in our world. And no surprise, Moritz, I thought I was going to come to you
want me to
for
start?
a change. Just because you're so good at this, Moritz.
Well, yeah, good, but still down for the year. I'm at like -6-ish, something like that. But nothing much happened in the past week for me. I mean, I did lose money. We'll hear from Jerry in a bit, I guess. Maybe the opposite, hopefully the opposite. But I did lose money on the equities. Net, I'm still short those markets, and they rallied in this past week, so that cost money. Made some money on the currencies. I have short positions in the Swiss franc, Japanese yen, euro, the Canadian dollar. Those have all been good. Did make some money on the natural gas, but the other energies didn't do so much. So bonds about flat. Like I said, all in all, flattish kind of week. Didn't get me out of my -6% hole for the year.
No, I mean, very, very similar picture on our side. I mean, the losers really were energies, equities, things like that. And the only real winner was currency and volatility. We also lost some money in coffee and copper. So, yeah, small losing week for us as well. And I was looking at the trend barometer this morning just to check, how that was doing. And I think we're down to something like 27 or 29%, which is really low. Normally, I would say 45% of markets in that portfolio should be, in some kind of trending state to be neutral. So when we're down to the 20s, it certainly is an illustration that there's not a lot of opportunities for these kind of strategies at the moment, completely objectively speaking. And therefore it's, it's been a slightly difficult start to the year. And before we jump to you, Jerry, the other thing I kind of noticed, I mean, I'm coming over to Florida this week because we have these annual conferences that we all go to. And I remember very clearly last year at the conferences, everybody was smiling, happy. Q4 2017 had been great. January 2018 was just fantastic. Everybody was off to the races, very strong performance. And of course, we know that that was pretty much the high for the year, or it was the high for the year. And so I was looking at a little bit of, historically saying, well, it's now been a year, and certainly in our case, since we had our last new high, and a year when you're so close to it can feel like a really long time. But then I started looking at some of the other things that investors, I'm sure, are very familiar with, what they follow. And of course, I ended up looking at equity markets in particular, and maybe European markets especially. And it's quite interesting because a year, as I mentioned, feels like a long time. But people investing in the Euro Stoxx 50 index, the last all-time high was in year 2000. I mean, that's an 18-year drawdown. The same with the Italian market, the Dutch market, the French market. They're all peaked in year 2000. Then you've had sort of the next group of markets that peaked in 2007 before the next crisis. Countries like Ireland, Austria, Belgium, and Portugal. And so that's an 11-year drawdown. And then you've got a few markets, including my native country of Denmark. And then you have the FTSE, Switzerland, and Germany that, and of course we know with the US, peaked only a few months ago, 4 or 5 months ago. So I think sometimes it's useful to put these things in perspective, because a lot of people get focused on this thing about, but trend followers are in a drawdown and it's a long one, and we get tired of it, and it's boring to always be away from your new highs. But I think sometimes we forget that other asset classes that people are very familiar with have had much, much longer drawdowns and are still in some of them right now compared to what we do. So just wanted to throw that in there, Jerry, before we hear about your week. And I'm excited actually to find out how different what you do in the equity space compared to what we do, but maybe more in particular compared to Moritz, because I think your strategies are much more similar. How that's panning out right now.
Well, just trading the single stocks and not getting all swept up in the big down move was great for 2019, of course, not my December, which was very bad. So just a few shorts, but mostly a few longs as well. So being able to look inside the indexes and get a few stocks from each of the different sectors and categories, it provides lots of diversification. Sure, on bad days, all my stocks are down, or on the good ones, they're mostly all up. But the chart patterns look just as different as the currencies, commodities, or interest rates would, what we'd expect. So it's really kind of a difficult puzzle to figure out, okay, I get a lot of diversification from these individual names 90% of the time, but the other 10% is really unfortunate and dominates performance sometimes. So how do I handle all of that? So we got lucky this time in maintaining longs and very few shorts. So that's good for us. And then in energy, we didn't go short many energies either because of the high volatility in the markets. We just tend to take small or no position until the markets kind of settle down, sort of a little twist on the trend following that we do. So, but yeah. I agree with the other markets. It looks like that with the rally in the stocks, we are seeing some rallies in commodities, metals, grains, energy, all losers because we're short those. A few longs like the cattle, palladium, still got a few longs, trying to find more. It's hard.
Yeah, the markets have certainly been gyrating recently. There was another article I saw somewhere where someone had quoted for the last 3 months Fed Chair Powell's statements about rates, and they really are alternately hawkish and alternately dovish. So no doubt that the markets maybe is feeling a little bit confused when you see what's coming out from officials like that.
It was a big.
What happened? Yeah.
It was a big week, of course, for the passing of the founder of the index fund, and I think that it's very interesting to just step back and, we don't trade like that. We don't probably agree with that as it relates to long only or stock only or something that's other than trend following. And I think that it's really interesting to hear your list of other stocks around the world that are in drawdowns for many years. And there was people getting uptight this week about criticism of the index and bringing up Japan all the time. I was caught up in a Twitter battle of, why do you keep bringing up Japan? Thank you for bringing up a lot more. And I thought it would be, but still, it's still a situation where regardless, now you just have to look at the United States, maybe the S&P only. I mean, how much more narrow is it going to get? And then they're still subject to an 8% return on average and a 50% drawdown, which doesn't sound very good to us. And maybe, more worse markets to come for that style. I don't wish anything bad on them, but in hindsight, when you're in that 50% drawdown, I think they may have a little more clarity as to why it looks silly to lots of other people.
No, absolutely, and sort of in just following on from what you said about Jack Bogle's passing, and clearly he has had an enormous effect on the financial world with the way he came up with the whole concept of indexing so many years ago, and it kind of reminded me of something I was listening to or watching on the way over yesterday on the plane, and because we often hear this thing about, but trend following has had a difficult time. So, will trend following ever work again? I mean, and it was partly a conversation with Harold de Boer from TransTrend, who has also been on the podcast. So there's an earlier episode with him if you want to listen to it out there. But he talked about certain fundamental shifts that happens where we kind of never gonna go back to the old ways of doing things. And these are things that are maybe easier to understand and visualize why trends happen. And to me, the whole point about indexing, for example, how much that has really changed the financial world, and the promotion of lower fees and so on and so forth. I mean, no one in their right mind is going to go back to the old ways of doing it, paying higher fees, for example. I mean, that's a fundamental shift. And there are, of course, many other examples of these things in other industries. So I think this is a useful way of thinking about why trend following fundamentally works. And I also like a comment, and I'm not sure whether it's in the first part of my conversation with Andrew Lowe that I published on Wednesday, or whether it's the second part that comes out on Wednesday. But he also tries to talk about these models, these approaches, a little bit like in a sort of Darwinian way. I mean, survival of the fittest, that, they do adapt over time to ensure their own survival, so to speak. And I thought, again, that was not something I've actually really heard before. And I like the way he explained things. I'm not doing it justice right now because I can't remember it word for word. But I think there's some interesting ways where we as an industry may have to maybe change the way we try and explain why what we love and what we do will continue to work. And in fact, actually, one of our listeners, Michael, sent me an email the other day talking in somewhat similar terms from just what he had read and listened to our conversations. And it kind of reminded him a little bit about this. And I think that is it's a great way of looking at things. Don't know if you've ever thought about this.
Yeah, what I have thought of is I think that what's happening here is the adoption of rules-based. So I think that that's where we've been for our whole career, rules-based. So I think what's happening with these indexes is they're a simple index with published rules, and markets, long only, can usually beats discretionary trading. And I think that that's pretty sad and not anything that we would be surprised by. So I think, like you were saying, I think lower fees are here to stay. And I think in the history of business, what happens is in capitalism, usually we get better stuff, more stuff for a cheaper price. And I think the next wave will be further adoption of more rules-based and recognition that we're not really talking indexing here. We're talking systems and rules versus discretion and lack of rules. And I think that's where, CTAs and trend following can be the next big wave beyond the first wave of stock indexing, that adding currencies, commodities, stocks, bonds, longs, and shorts, and maybe with the trend following systematic overlay will give people better stuff, better returns, better risk-adjusted returns at a fair price, maybe a cheaper price. So I look at this as we're next up, and this is not the triumph of indexing necessarily. That's missing the whole point. It's a triumph of rules-based, which we're all for. That's what we do.
It could be even more like, we have those robo-advisors using rules, maybe some markets portfolio optimization. Just like Jerry said, I mean, we could be the next leg up where some of those robos become more intelligent robos, if you will, and do trend following, long and short instead of long only. And I agree with that fundamental description. I mean, we live in a changing world all the time. Sometimes it's maybe hard to recognize that, but we have those underlying currents and those massive shifts. I mean, 3-4 decades ago, the computer came up. People were, I think that was Harald de Boer's quote, they were, using waterways to travel in Amsterdam, and then the cars came up. Maybe now we're going from, into electrical cars as opposed to gas-driven cars. Things like that happen, and we may have to change the way that we follow trends and adapt to changing markets. We're saying this all the time. Modify our trend following systems, maybe ever so slightly if need be. But the overall framework is just very healthy to apply a trend following style. It's the best thing out there.
And I think in hindsight, we'll look back, or my children will look back. This could take a while, the complete domination and takeover by trend followers. And say, it really wasn't that big of a stretch to think that people could accept commodities or currencies. It really wasn't that big. People, as we know, as we sort of, some of the tweets this week were just, everyone is just going to be overly influenced by recent performance. And so if the commodities had a run like the stocks, the S&P 500, it'd been easier to sell. So I think it looks almost impossible now to think that people are going to love on those markets that we trade every day like they do the stocks. But stocks down, our performance up, it could happen pretty quickly. And the appropriate leverage, the appropriate fees, appropriate explanations, these, like you were saying, these all matter. But what's next? What's the big improvement over 8, average rate of return of 8 and a max drawdown of 50? I mean, who's going to offer that? Us. It's going to, or we won't. But I don't see anybody else with the type of possibility and the capacity that the CTAs have.
I love that thought. Total domination of trend followers. So you heard it first here, January 2019, total domination of trend followers. No, and it's kind of interesting, right? Because a good friend of mine went to a Goldman Sachs conference this week, and he called me up and said, you won't believe what they're saying. And in summary, basically, this was, I think, a guy, head of commodities or something like that. And he was basically saying, people really shouldn't call Goldman Sachs anymore to get advice of what's going to happen with these price moves, because it's all driven now by systematic trading, and they're really the ones winning the battle. So the way we used to, make our forecast and price things, et cetera, it's not that accurate anymore. It doesn't really work. And I think also there's been many articles written about, the most successful, investment funds or hedge funds, whatever we call them nowadays. I mean, I think if not all, but 8 out of 10 of them are systematic in terms of the best performing funds. So I agree with you, Jerry and Moritz.
I do think that there's one.
Yeah,
I do think there's one thing that the CTAs, of course, I'm a broken record, need to improve upon, which is trading stocks and getting away from indices only, and then maybe trading more stocks, where I think that could be a bridge to final acceptance of massive diversification. Would be these products that Abbey Capital and Milburn have come up with over the years, Milburn especially for a long time, Abbey recently, mutual funds or products that are mostly stocks, 50% stocks, and so in the balance being currencies and commodities and bonds. And so instead of asking people to allocate 2 to 4% to us, the number's gone down in case you didn't hear this week, but then we create the one-stop shopping. Here's your equities, maybe a little bit of risk control with trend or relative strength on the 50, 60% of the equities. And then we're going to also provide more diversification with the currencies and commodities and bonds, long and short. So I think these guys are out there, and I think this is going to be a very compelling product. It's still stock-centric country and world, but introducing the individual names and creating a portfolio of that, 25% or 10% of your portfolio that is stocks, and with individual stocks is something the CTAs have got to start to consider in mass. It's very rare. Chesapeake and TransTrend and maybe a few others, but
yeah, it's interesting to hear you say that, Jerry, because 22, 3, 4 years ago when I worked for you, I remember that we were toying with that idea. If you remember, I think we had the financials and metals, and we wanted to create like this portable overlay, portable alpha, I think we called it, which was, I think, a traditional portfolio overlaid with trend following.
That's right.
And I'm not sure it's so it's obviously going to be an evolution, right? So I agree with you that ultimately maybe that's where we're going to end. But and I know that our listener Michael has actually written something in the questions today, and I don't know whether it's a real question or just a comment, but it's kind of the same thing. That maybe we as an industry, we need to change the way we serve the dish, right? We need to serve it in the way that people find it, appealing, and we're not quite there yet, because even though we think our dish is the best one right now, it may not be exactly, what people would like to eat, so to speak, if we stay in that metaphor. But I agree with you that, I mean, that's hopefully where it's heading. Why don't we look at what happened in the news flow and some of your top tweets? Jerry, of course, I couldn't help myself not noticing the one, and maybe it was one of yours or someone else tweeted about this pension fund or whatever it was. Someone was considering making an allocation of 2 to 4% to trend following, ditching something else, which I can't remember what it was either, but it's just that 2 to 4% number that kind of hit a little bit of a nerve, I think, with all of us, in the sense that, what does that mean? I mean, does it mean anything to allocate 2 to 4% to this space at all if you're trying to get true diversification? So that was one that I noticed. Maybe that wasn't the top tweet for the week.
Oh, I think that's a great one. I think San Diego Pension has experience with CTAs, so that's a nice headline. And then as you read deep into it, one of the things that struck me was their desire and ability to extol the virtues of how great CTAs are. And at the very end, it's 2 to 4%. So I think this is just, if Crisis Alpha and allocating to CTAs can't get any sillier and meaningless, I don't know who's going to top this. But so anyways, the quote is, CTA allocations improve the fund's diversification, particularly in downtrending stock markets and without material compromise on expected returns. As a result, they're studying it, can't probably pull the trigger quite yet, of a 2 to 4% CTA allocation And what about that statement? Without material compromise on expected returns, who else can give you any allocation to some other asset classes? Can it be expected to have this similar return to stocks? And so we're going to add value to equities, not costing no opportunity cost on returns, and add diversification. So as Meb Faber said, and as many studies have said, meaningful allocation of up to 50% probably is warranted, and more if you don't use recent stock market returns as part of the formula.
I think it all rubbed us a bit the wrong way. I think, Niels, you said, I think they're aiming for a pie, which is 3.14 something. So the 2 to 4%, we all agree that is very immaterial within a larger portfolio. But in fairness, maybe just to put that into context of a pension fund, if they are, asset liability driven in their allocation, meaning that, they have a certain amount of liabilities that they model going forward. And as a result of that, they're essentially forced to, depending on regulations and things, but they're forced and inclined to invest a lot into bonds, sovereign bonds, corporate bonds, just safe assets. And maybe they only have room for about, 5, 10, maybe 15% of more risky allocations. And if within that bucket, they're putting 2 to 4% into CTAs, then maybe that becomes within that bucket a meaningful allocation to them. I mean, yes, we all know that it's not going to be that visible on an overall portfolio level, but I just wanted to throw that out, that they may have very different guidelines and restrictions in terms of how they can invest.
Of course, and I think that's a fair point. But it's interesting the way you describe bonds as being safe, right?
Well, perceived safe, yes.
Right, exactly, because that's the way we're kind of conditioned now after 35 years of falling interest rates. We think it's safe.
Yeah, it could be the riskiest investment out there.
Exactly. Could be the riskiest investment for the next generation, right? If we have another 35 years of rising interest rates, or if we have defaults that we haven't seen for a long time because there's just too much debt in the world, according to many people. So, yeah, I mean, it's interesting. But it's different, right? It's certainly different from what Callister's is doing, because in their portfolio, where they are trying to specifically use that for risk mitigation, I think their allocation to trend following is something between 35 and 40%. Or maybe they just, missed a zero in that quote. It should have said 20 to 40%. You never know.
Somehow getting the large investment firms and pensions to understand how valuable the trend following could be for the stocks would be a great coup for the CTAs. And so somehow, since we're not even trading stocks really, very much, we got to adopt single stocks first, and then possibly get in the portfolio and say, if you really want all these stocks, okay, whatever, but real crisis alpha is going to let me use my systematic trend following with small losses, trailing stops, and minimally, I won't be fully long when the stocks have bad periods or crash like a lot of part of last year. So that's the next step too. Let's get in there with real crisis alpha on your stocks for a good systematic approach.
And still make money when equities go up. I mean, that's the other part of the beauty of these strategies. I mean, 2014 there were no crises. It was one of the best years for trend following.
2013, we made 20%, and it was all stocks.
Yeah,
our stock only fund was up 60%. So these are great trending markets that we kind of ignore, and then the mainstream investors sort of ignore us with our better approaches.
Yeah. What else got some attention and love in the Twitter world this week, Jerry?
Well, I particularly liked the study about how stock pickers don't know how to sell. They're great at buying, but their selling is worse than random. And I read a little bit into the article, maybe, but, well, here's the quote. Managers have greater propensities to sell positions with extreme returns. Both the worst and the best performing assets are sold at rates more than 50% higher than assets that just under or overperformed. And so my takeaway was, they're taking large losses and they're not letting their profits run. So I doubt that when they say that they do sell after extremely good returns, they're probably still leaving money on the table, as I've done and we all do when we don't allow for the market to go as far as it wants to go without us having a predetermined idea where enough is enough. We like to think, okay, it's been up 100%, maybe I'll get out, but then it goes up 500%. So they're probably subject to the same feelings we have if we were not using a systematic approach. So I thought it was very interesting that we all kind of realize how important single trade profits can be with the perfect choice of the exit. But these guys are having worse exits than random because they're probably not following a systematic approach.
Yeah, I mean, it's one of those classical human biases that we have. I don't know if it's called confirmation bias or whatever it is, but I mean, by selling a winner, they obviously are proven right? So it's something that makes them feel good. And so this is very classical, Kahneman type stuff where, these are the biases that we fight against, and that we have found a way to, help us overcome by being 100% systematic and disciplined about it. So yeah, it's funny sometimes that you see these articles where you think, well, there's nothing new in that, but then it comes out as something. It sounds new, but it's really not. Interesting, yeah. What else did you pick up in your troll through the media?
Well, a lot of people liked this quote. Strategy diversification guarantees we will be wrong. Every year, we will allocate capital to the worst performing strategy. The potential edge is in being vaguely wrong, which is annoying, rather than precisely wrong, which can be catastrophic. So it sounded a little similar to a quote that Moritz had recently.
Yeah.
So this is where we are, just good enough. We don't want to be too much better than just good enough. We don't want our systems to be too cherry-picked and too overly optimized. And with the major competition out there, stocks, indexes, we don't have to be very good anyway. So I've tried my entire career to find different strategies, maybe what this quote is hinting at, that added value, but during bad periods or periods where my better systems were underperforming, but I haven't been that successful at adding sort of crappy stuff to good stuff. So I've pretty much concentrated on adding markets and single stocks and more commodities and currencies and things like that. So that's cost-free and nothing but benefit when you add diversified markets, but still trying to find something that can help me in periods where my better systems don't do well.
Yeah, absolutely. I mean, I think it's this thing about, a lot of people out there say that, yeah, I mean, the theoretical, idea of diversification works, but in practice, maybe not so much. And I think I saw someone had written about, diversification works eventually. And I think that word eventually is very important because clearly in a year like last year, doesn't really matter what kind of investor you were and what kind of portfolio you had. There are a lot of things that didn't work out last year, but it doesn't mean that diversification isn't the right thing to and the right way to go about it. So, any views from your side, Moritz?
I'll agree with that. Not much to add. I mean, we know there is regression to the mean, and especially if you're following a portfolio of systematic strategies, you'll find that some strategies will underperform the one year and maybe outperform the next. So keeping on allocating and investing and putting money behind all of those, that's the right thing to do.
Certainly is.
Also enjoyed your interview with Andrew Lowe and
thanks.
Saul Waxman. Really great.
Yeah.
I tweeted one of Saul's, I think I got it mostly right, one of his quotes, but people liked. Investors misrepresent what they want. Despite the talk of diversification, they favor strategies that have been most profitable recently. They have a lack of interest in diversification when it hurts returns. So it doesn't matter who we're talking to, the smartest guys on the planet or the least sophisticated. Everybody has these human wants and needs, and we just have to stick with what we do. I get calls and emails a lot these days from traders and friends, experienced and inexperienced, and everybody's stressed. And every day I walk in, I'm down 30 to 50 basis points. What do I do? I just say we're all doing the same thing. We're all having the same feeling. Remember back in 1984, when we first started trading in the Turtle program, immediately we were down 20%. And Rich just comes in and says, it's just totally due to the trendlessness, and don't worry about it. Keep doing the right thing. Keep doing your trading. Here's more money to manage. And then we ended up having a really great 1984. So you just gotta hang in there.
Yeah, it's so important. Yeah,
we need more people like him.
Yeah, I mean, luckily there's still a few investors who see it like that, and who knows, how to both manage the emotions, but also make sure that they get in, during the drawdowns. I mean, I think that's something that most investors fairly easily, when they study trend following and they study a performance chart, can see that clearly it makes sense to consider adding or entering these kind of strategies during stressful periods of drawdown. But as you rightly say, Jerry, and as I think Sol was quoted for, a lot of people tends to just focus on the most recent performance, and that doesn't make for a sound investment strategy in the long run. That's for sure. But I will say, by the way, to for those of you who listen in today and who haven't listened to Andrew and Sol, it's definitely worth doing it. There are veterans in this business, and Andrew Lowe in particular has given a lot of really valuable discoveries to this industry over the years, which is why he received the Pinnacle Award last summer. So definitely check that out. What else did we see in the news?
Well, I got a nice response to just something I blurted out in response to what people were tweeting about how a lot of systematic traders are agonizing over the recent whipsaws. What may seem like minor whipsaws over a long backtest are experienced as a major event in real life. And that is so true. I get the backtest, I get the performance, and I'm so psyched. And then I start living with the systems or the tweaks, and oh man, it's so much harder living on a day-to-day basis with little up zigzags in the charts. So I wrote back, falling in love with a trade and a narrative causes anxieties. Our rules-based systems are subject to our emotions and fears. So I don't know of anyone who where it's not possible to maybe feel bad when you lose money, even though you're committed to a systematic approach.
Yeah, no, absolutely. I mean, it can be tough even if you've been doing it for a long time. So I can't imagine how difficult it is for people just getting into this space. But I think also, again, coming back to this thing about, I think people have forgotten what a 50% drawdown in equities looked like. I think they got a little bit of a taster in Q4, where suddenly markets, or the US markets, went down by about 20% in a matter of weeks. So it's kind of a little reminder there. But there's a big difference being down 20 and then seeing it rallying after a bit of help from the plunge protection team. And suddenly we're only down, 8 or 9 since the last high. But, being down, I mean, and someone was, I think I heard a podcast recently where they were going through Ray Dalio's latest book on debt crisis. And I think maybe one of you, or maybe it's you, Moritz, who've read it, but apparently in the book, Dalio goes through I think pretty much month by month, some of these crises and the amount of swings, the 50% drawdown in equities, followed by a 48% rally, and then down another 50%, and so on and so forth, and how some of these equity crises end up lasting 3 years, which is more than both of the two most recent equity crises lasted, and how what that must have felt like if you saw that kind of volatility.
I agree. I've read it and I've found it really, really interesting. And it puts it back into perspective. Like right now, it's tough. Had a bad start to the year. 2018 was negative year, so you kind of like wish for that to stop. Okay. But like Jerry said, it's because you live in it every day, day in, day out. Your emotions, they become a part of that. You may look at the backtest and you may look at Ray Dalio's charts and there's going to be a lot more volatility in those periods and maybe that's coming back. But regardless, it's in a chart that is, 80 years in the past. You can look at that how many times you want. It just is no replacement for what's going on in real time.
And on Twitter, people, and in real life, people are so invested. They're so invested in this move. The buy and holders are invested that it keeps rallying. You can't predict. You can't time. Then the people who are short and Trump haters or valuation type people, they're so invested that it keeps going down. And so we're sort of immune to that. Maybe we're invested. I'd like to make money, and I hope your short positions work out in these stocks. And I hope the industry has better performance this year. But none of our actual decisions and trades are going to be impacted by being emotionally invested. The worst case is we're just sort of not feeling good every day when we lose money. But thankfully, we're not a part of letting these emotions usually impact proper trading.
Yeah.
No. And again, part of some of the questions that I've received from our listener, Michael, this weekend was also going back to something that he had asked a few weeks ago. And this is a little bit about why we generally sound pretty calm about things when we talk about it. And I think, and it is, of course, we're saying the same thing in different ways, but with this approach and where you have rules to follow, a lot of things become unnecessary in your life, even as an investor. You have managers who only analyze the markets once a week, and they find that is enough for them to run their systems. I've certainly had guests on the podcast that does that. But it's also the fact that you can exclude the noise. I mean, as you said, Jerry, there's so much noise. There's so many people are invested in these moves at the moment. So the news flow is overwhelmed by opinions, and usually they're negatively loaded. And all of that, I think, chips away on us, even on a subconscious level, if we have to listen to it all the time, even if it doesn't concern us as people directly. And I think that's what's so great about what we do. In theory, we don't really have to look at the news flow at all. We just need to be able to download our prices on a daily basis and run the rules and make sure to follow them. But I think, and that's such a relief. And I think, and maybe maybe I'm going to go into a little bit about the questions now, Jaron. You can always come back with more tweets. That's perfectly fine. But I think that one of the things that Michael also talked to me about, and I'd like to bring it out to you guys, and because I think in particular you, Jerry, are probably the one who are the best example of it, of the three of us. And that is this trying to live life through the lens of being a trend follower, not just when it comes to the markets. And so I don't know if maybe you can speak a little bit to that point. I know that Michael was very interested in that, and I think it's interesting. But I also love to hear your views, Moritz, on that. How can we apply trend following to other things than the markets? Maybe that's the kind of the bigger question, or can we?
I think a lot of what a good way of applying it for me has been over the years. I was introduced to all these ideas by being in the Turtle program, of course. But I remember Rich saying one of his not only motivating but profitable ways of doing research was to try to prove cliches wrong. And it was easy because the cliches were wrong. You can never go broke taking a profit or things like that. And I think that having that sort of contrariness in life in general, when everyone agrees with a certain cliche or certain way of looking at life in any subject, just to be a little skeptical and be kind of not so accepting of things that everyone else takes for granted as it's basically because they're lazy, and it's hard on your brain to say, really, I can't count on that. I'd like to count on some things in life and not have everything be up in the air. So I think that's been probably the best, one of the best gifts I was given is just is introduced to that sort of mindset.
I mean, again, just before I want to hear your thoughts, Moritz, but just when you say that, Jerry, it's something that strikes me, and that is this, and I think you're absolutely right, that people want to have something to hold on to, right? We want, whether it's a cliche or whatever, we want something to hold on to. But funnily enough, when we try and get people to hold on to the basic thing that trends will continue, there will always be trends for whatever reason, unless all markets get completely controlled, and which I don't think you can, even if you want it, then trends should always occur. Very, very basic, human behavior, so to speak. So why is it that it's so hard for people to kind of hold on to that part, which to us seems quite a logical thing to ground our belief in, that markets will continue to move, sometimes more, sometimes less, but there will always be changes that are big enough over time for anyone to capture using a rules-based approach.
Yeah, we certainly hope so. But back to the living the life of a trend follower and seeing life through that lens. Well, there are a couple of things where that works and where I believe it's very, very beneficial. There are others where, I've heard people say everything I do in life is in a trend following way, family life and things. Well, I'm not so sure about that. But I mean, what certainly it has given me is that, that fact-based, very objective compass about markets and decision making. I have just no interest and no more time to get involved into all sorts of silly arguments about why a certain stock, Tesla, whatever, should be going to 400 or 200. It just, nobody knows. People just make that stuff up. And sometimes, I feel still sorry for those guys out there that operate in that spectrum, because it's just a much, much easier way to go about things. Just follow the price, take the right position size, and forget about all the rest. It frees up so much of your life, gives you so much life quality. That's what I have found. If you have that system and the way of going about things, it's all uncertain out there, and you're not making money by winning the argument contest and theoretically being right about things. This is not why we're in that game for. At least I'm not in that game for that. It's about having a robust methodology and making money in the capital markets without blowing up.
Absolutely. Well said. Anything you want to add to that, Jerry, or otherwise I have a question from George?
Oh, good. Let's go to George.
Let's go to George. So George writes, and thanks for this, George. And by the way, thanks, Michael, for some of your comments. There may be more as I read it again. But let's jump over to George. And he says, when I started listening to the podcast, I would have guessed your competitive advantage was the secret sauce, system logic, generating signals. That said, you're all rather transparent about your systems and generally agree 90% of success comes from following the general rules versus system specific. So I'm left wondering, what do you believe is your competitive advantage? Great question, George. So, Moritz, do you want to kick off? What do you think your competitive advantage is?
Competitive advantage compared to whom? Renaissance Capital? Well, none. Competitive advantage in relation to a long-only passive equity fund? Many, many advantages. But what he said is right. I think the greatest amount of success and advantage stems from the fact that we have all come to apply what we believe is a robust set of rules. Robust, roughly right, not too fine-tuned, just getting us roughly into the situations and the trades that we want to have at a certain point in time, and following them over and over and over again with tenacity, not giving up about this, even during periods like right now where maybe the daily going about this system is a bit tougher than usual, or tougher than I'd like it to be. But that is an outflow of that competitive advantage. Lots of diversifications, treating all the markets in the same way, treating all the trades in the same way, and operating within that framework for years, and getting the experience that comes from that. I hope that is a good enough summary of things. But other than that, it would be complete wrong to say that, my system has a certain entry or exit methodology that is so superior to all the other entry and exit methodologies out there that this is where my competitive advantage is, and therefore people should be giving me their money because I just have some sort of alpha generating capacity on that system. That would be plain wrong. But overall, the entire thing, including the risk and the money management, all the markets that I trade, the way I do it, that gives me an advantage to a large number of investors out there who don't do it that way.
Good stuff. What about you, Jerry?
So I like all of that, and I think that's a great list. I won't repeat those, and I'll try to find a couple more, maybe within the CTA field. I think that I don't do any counter trend trades. It's just trend trades only, so no vol targeting or take profits. So I think that's kind of important. Fixed portfolio, very important. Single stock futures, of course, love the diversification there. I think it's you just want to have a system that has an entry, has an exit, it has a stop loss, and you want to do those trades and not allow kind of money management or portfolio adjustments or vol targeting to have a big impact on those trades. I think that's a big thing as well, which I've said many times. So another thing that's underrated, because I've made mistakes in this area, is changes, infrequent system changes. That's very important. Since you're already admitting that just good enough is good enough, and we're not trying to find the best, if anybody could, systematic approach and rules, then leave them alone. Once you figure out that you should be medium to long term, it's very important to do those trades in that system and not change them very much. So when your time comes, you'll get the profits that you deserve because you paid for those profits with losses. That same system didn't do very well over a certain period, which is predictable. So not making too many changes, evolving, but not evolving too much.
Mm-hmm. Yeah, great stuff. So I'm also going to try and answer this more specifically in terms of, even narrowing it down further just to the competitive advantage within trend following that we might have. But it doesn't mean that I disagree with what Moritz and Jerry said, but I want to take it one step further. So the way that I look at trend following is that there are three things, and this is something that pretty much all strategies have in common. That there are three choices that we have to make on a daily basis, and that is where to enter, where to exit, and how much to risk. So in my experience, at least, and if you look at various different models, I don't think that one model compared to the other, or I say model, but it could be approach like moving average, crossover, or breakout, or whatever it might be, time series momentum. I think when you look at these approaches to the markets, I don't know that any of them are better than the other in terms of identifying trends. I think most of them identify trends more or less at the same time. So I don't think that there's a big competitive advantage whether you choose one or the other. But I also think that the weakness of trend following that we all know and agree on is that trend following can be tricky when there are few or no trends. We know that. That's where we lose a little bit over a long period of time. Or it can be tricky when there is a sudden reversal in many markets, many sectors at the same time. We lose a lot in a short space of time. So when it comes to competitive advantage, I think that those are the two areas where we should strive to improve. So finding better exits and finding better ways of managing our exposure. It doesn't mean that I do not agree with everything we've said so far about, just being good enough. I think that is absolutely true. But we're also fighting for, delivering the best possible output to our clients. And for most of us who are in this business, it's also to ourselves, because usually the managers are very large portions of the assets managed in the program. So of course, research is about trying to find things that can make things a little bit better, incrementally better, not making too many changes and not making changes very often, as Jerry just said. But so I think that if you are looking to find a competitive advantage, and I think that's certainly one area that we've tried to find better recipes, it is in the world of how we exit the market, and it is in the world of how do we manage the overall risk of the portfolio. Is there a way for us to identify when there are fewer trends around in general, and therefore not necessarily run at full speed? So, at our shop, we used to run at full speed in terms of risk every single day, regardless of whether it was a good environment or bad environment for trend following. And of course, intuitively, we knew that that's not a good idea, because when there are no trends and just a lot of choppiness, you get a hell of a lot of unwanted volatility in your returns. And it wasn't until 5-6 years ago we were able to find a better way of doing that. So, and I think that has helped. So I think that is an advantage that we didn't offer before. Whether it's so much better than others, I don't know. But that I would just give that as an example of where I think you can still find ways to improve. So a little bit different answer to Moritz and Jerry, George, but I agree with what they've said as well. I just wanted to try and make it a little bit more specific from my point of view. I think that's pretty much what we had in terms of questions. I should say that we now have a time and a date where Meb Faber will join us, which is very exciting. So I would encourage you, the listener, to send us some questions. It'll be late February. Send us some questions that you would want us to bring up with Meb. He obviously comes at this area from a slightly different angle than we do. So it's going to be super cool to discuss that with him. So if you have questions, we will collect them and we will save them, and we will, have a good discussion, trying to put your views and your questions forward when the time comes in late February. Let me just quickly run through before we wrap up at the end. Let me run through how what performance looks like. This is as of Thursday, so the 17th of January. And I think without a doubt, Friday was a bad day for the industry or for trend followers in general, at least. So these numbers are probably a little bit light in terms of where they are at the end of Friday. But anyways, the BTOP 50 index was down 1.76% for the month. And the SocGen CTA index down 2.18% for the month. SocGen Trend Index down 3.05% for the month, and the SocGen Short-Term Traders Index down 1.48% for the month. And the bridge alternatives, the flat fee index, was down 3.35% for the month, which of course also is the year-to-date number since we are in January of 2019. Anything else you want to bring up before we wrap up for this week? Except that I should mention, since we are close to the conferences coming up, I know we're going to hook up with George in Miami. If there's anyone else who wants to hang out, let us know. We are there for a few days in Miami in the last week of January. So we're always interested in meeting some of you, whether you are a competitor or a listener or something, let us know. We'll be there. Anything else, Jerry, Moritz?
No, welcome to the United States and look forward to seeing you guys.
Yeah, same here. Great.
Absolutely. Well, safe travels to you, Moritz. I'm not sure whether we're going to record before or after you fly over next week. Maybe we'll do it before. So we'll speak again before you come stateside. And on that note, we'll wrap up this week's conversation, which we hope you enjoyed. And, we appreciate all the questions. So keep them coming. Send them to info@toptradersunplugged.com or tweet them to one of us, and we'll get a way to get some answers on the next episode. And of course, if you feel you're getting some value out of these episodes, please do leave a rating and review on iTunes. It really does help us and other investors to discover the Systematic Investor Series. From Jerry, Moritz, and me, thanks so very much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.